And welcome to the Ramp Up to Retirement podcast with your host, Dan Reese. Dan, it is that time of year again, and everybody listening knows what that means. It is time to talk about taxes, my friend.
Oh, yeah. Everybody loves tax time. It's funny, but it's a reality. We all have to deal with it every year, right? So, like, one of the things that we always talk about, like our company kind of tagline is optimize your financial future. Well, one of the areas you can really make an impact on your finances is through, good tax planning. So that's kind of why we're touching this subject this month. And if you listened last month, we did talk a little bit about we're going to be very structured this year with each month touching on things which we kind of laid out last month. And so February's taxes. So let's get after it.
Let's get after it. And I suspect that, like many people, I approach taxes from the sort of viewpoint of, okay, what do I need to get things together? And I do actually create a little checklist because a couple of years ago in a panic, I realized I'd sent all my materials and, information to my accountant and realized I'd left some stuff off. And I had to rapidly get a hold of him and say, wait, I've got other stuff I need to send to you. So let's get started with the list, Dan.
Yeah. Just to mention one thing, like you're talking a little bit about tax prep, which we're not going to get into as much today. We're going to talk more about some different ways to or things to consider around taxes. But I will say that a lot of CPAs have done a really nice job with presenting kind of like a checklist for your preparation.
Yeah.
And if you've worked with them, what's nice is that a lot of those forms even have kind of the prior year's data on there. So it makes it way easier to go through and, you know what I mean, and make sure you're not missing things.
I do. Unfortunately, I know exactly what you mean.
Yeah. The challenge comes in, honestly, is when, for example, one of the big things that trips a lot of people up is if they happen to open a brokerage account, like a non-IRA, because those 1099s tend to come out a little later, middle to end of February.
Right.
And so people are in a hurry to get all that stuff together. And if they've never had that before, you know what I mean? They're not really looking out for it. Exactly. And so that first year, so things like that can trip you up. But overall, my recommendation, follow that kind of that tax planning list or preparation list that the accountant gives you. And generally, it helps avoid a lot of, the things that you can miss otherwise.
Yeah, it does help with the prep. But we're here to talk about, and you're here to talk about planning, which for a financial advisor seems to be your pretty solid home turf there, my friend.
Yeah, and that's a good thing. I'm glad you just said that, planning, right? Because, there's a big difference between tax preparation and tax planning, right? Tax preparation is basically getting all the data together and completing a return, right? So we're going to talk about planning today, and we're going to break it into some different categories. We're going to start out with income tax planning, right? Because there's some different areas. And so there's multiple things in here. And I'm going to start out with one called tax loss harvesting. And people might think, what in the world are you talking about? Tax loss harvesting, right?
What do you mean? Yeah, right.
And so the idea is if you do have those taxable accounts, which I referenced a minute ago, like a brokerage account. So we're talking about non-IRA money, right? So we do know if money's in a retirement account, basically you don't have to worry so much about what happens inside of that account from a tax perspective. All the tax accounting happens when money goes in or money comes out. But the day-to-day inside of that account you don't have to worry too much about, generally speaking. But if you have an after-tax account, generally many people refer to as a brokerage account or a mutual fund account that's not in an IRA, there's more things you need to pay attention to. And one of them has to do with what's called capital gains and losses, right? And so one of the great things about those accounts is that you do get that capital gain and loss treatment, which means that if you're a long-term investor, generally, you don't really pay taxes on things until you sell things, right? So if you bought, just a real simple example, you bought 100 shares of IBM or something like that, and it went from $10 to $20 a share, well, until you sold it, the only thing you'd really get taxed on is just any dividends or things like that were passed out during that time. But do markets always go up, Bill?
No, unfortunately, they don't. Not at least in the short term, they don't. No.
That's right. So, right, in the short term, you get a lot of market fluctuation. Matter of fact, I think I saw a report one time that said on average, like the US markets will go down roughly 10% almost every year, within the year somewhere,
Within
right?
there. Yep.
Yeah. And so what this tax loss harvesting really is about is that some of those holdings you have in those accounts may have lost money, right? And so sometimes you can sell those at a loss, and that's called realizing a loss. And then they can offset some gains in that account. So in essence, where you may have sold something that had a gain, you could offset it, and then maybe it prevents or reduces your taxes that would be due on realizing that gain. And so it's one of those things you do have to kind of pay attention to throughout the year, right? Because, the markets move fast. And so like you could have like a loss in something where you could have sold it and realize that loss. But if you didn't do it at that time, a month later, it could be back into a gain, right? And so there's ongoing kind of maintenance on that. And most good advisory firms will kind of help you pay attention to that and see if there's opportunities throughout the year for those types of things.
Yeah, I was going to ask. It sounds like something where you really need to be working with a financial professional, probably, to help you be aware and know what to do and how to take advantage of it.
Right, because one of the things that people don't fully understand is, let's say they spotted it in their brokerage account. They've got their online account at Fidelity or wherever, and they go in and they're like, "Oh, I'm going to sell that. That's a loss. I can get that, capture that." But they really like that holding, so they turn around and just buy it again. And there's things called wash sale rules, and there's all these other, there's rules around that. So if you do that, they may not let you take that loss, right? Because you're kind of trying to game the system.
Yeah.
And so that's the thing. You really have to watch out for those things, because there are a lot of rules, and you need to consult, CPA about that. And so you really know, how do I do this if I want to make sure that I'm following all the rules.
So where do we go from here?
Yeah, next thing is 529 plans is a great tax planning tool. A lot of us with kids in today's world, a lot of them are going to go to college or some other trade school or different things. And 529 plans have become really a nice tool because they have opened them up to be able to use them for more things. It used to be more limited as to what you could use them for. But what's so great about them is you put money in. We were just talking about gains and losses. If you put money into a 529 plan, and as long as you leave it there and then you use it for qualified education, any gains that took place in there are not counted, right? So you can take out that money, use it for education, and not have to pay capital gains tax on that money, right?
Nice.
Now, there's caveats to that, right? If you decide to use it for something else, then you could have some taxes and some penalties even, right? But it's a great tool. And even the state of Michigan's misaves.com, I've used that for my own kids. I think it's a really good program. The expenses are low, lots of nice investment options. And that's the one thing, too. A lot of people might think, well, I don't want to take a lot of risk with that. You don't have to. There's other investments in those plans that they're not as, stock-based and things. But it is a really good way to save on some tax dollars on an expense that most of us are going to experience if we have kids at some point.
Yeah, and this is a good opportunity and a good time probably to remember a couple of things. One is the rule of compounding, because you just touched on it. You don't have to take a lot of risk in these funds, because these funds typically, if you're funding them when your kids are younger, you've got a longer time frame that you're looking at. And Dan, compounding is a marvelous thing, isn't it?
It really is. And honestly, like to be true, those funds are going to be well diversified in those plans. They're trying to reduce risk, but yeah, stocks over time. If you've got 20 years, you should have a decent chunk in stocks, right? Because that's going to generally provide a little better long-term return. But nothing's without risk. So there's no sure thing.
No, there is no sure thing. No, there's not. But the other one is that, I remember when 529s first came out, the rules were really tight.
Yeah.
How have the rules changed? You referenced that the rules have changed somewhat, but how have they changed, Dan?
Yeah, I mean, there's a lot more uses of the money. It used to be, even some, I believe, back in the day had issues with, if you had it in this state, you really could only use it in that state. So if your kids went somewhere else, there might be problems. There was prepaid tuition versus like savings plans, which had all different rules. And I think some of those still exist, but a lot of them, what you see today are savings plans that are pretty flexible. And the other nice thing nowadays, like if say your kid gets a really great scholarship and you don't need to use that money, or you don't need to use all of that money, if you've had it a long time, they now have even opened up the opportunity to move some of that into Roth IRAs over time for that beneficiary. So like, let's say your kid gets out of college and you've had it there a long time. I mean, typically it's like a 15 years. You've had to have done it for a while. They don't want it to be a game, or like, oh, I just put it in and automatically did something different with it. But yeah, I mean, that's great because you can use some of that money towards Roth funding and different things, but really opening it up to more uses, maybe some like parochial schools, like say your kid goes to a high school that charges tuition, you could use it for maybe some of that stuff. Like, so there's just really been a lot more flexibility added because really everybody knows that it's a big issue paying for college. And so what they've tried to do is change some of the legislation so it gives you more of incentive and not so many worries about if the things don't go exactly as planned for your child, right? So it's been really good.
No, that has been great. And speaking of flexible, if there's flexible spending plans and there are health savings plans that you can take advantage of, do you want to talk about that a little bit?
Yeah, I mean, health savings accounts and flexible savings accounts are kind of a subset of that, are really great tools to use. I mean, you want to talk about a great tax benefit. I mean, a health savings account, you need to have a high deductible plan. And usually it'll tell you, and if you're signing up for benefits, it'll say HSA eligible or something along those lines.
Mm-hmm.
But what's so great about an HSA, which is one of the most unique accounts in the world, that's health savings account is what that stands for. When you put money in, it's a pre-tax contribution, right? So you're not paying any tax up front. And if it's used for healthcare, it's a tax-free distribution. So it's kind of like a super account, right? So like you don't pay tax going in, you don't pay tax going out as long as you're using it for healthcare. And the secondary benefit is it carries over in a health savings account. So if you don't use all that money, you can continue to accumulate in there. And many of the plans, you can actually invest it in mutual funds and different things like that. So you can grow it even. And there's little tricks that some people recommend. You can look it up online where they'll say, hey, just save your receipts, pay those bills out of your other money. And then down the road, you could take a tax-free distribution as long as you show that you paid those expenses at some point.
As long as you have a record of those expenses. Yeah.
Yeah. So it's really neat. And so there's a lot of huge benefits. We tell all of our clients, if that's an option for you and if that high deductible health plan is a good fit for your family, right? Because that's important, then it can be a super good tool to reduce current taxes and actually give you some tax-free distributions down the road. And the second part of that is the flexible savings account, which is slightly different because those are generally kind of use it or lose it and many times, although some of those will let you roll some money over each year, but not as flexible as a health savings account, but they're still a good deal.
Now, what would you use a flexible spending account for? Why would you need an FSA?
Yeah, so let's say you've got, hey, I know these expenses I'm going to have out of pocket this year, like for healthcare, and you kind of know it. You kind of like, you're a veteran of your health plan. Yep. You've got kids, you know what it's going to be. So you could say, hey, I'm going to set that money that I know I'm going to have out of pocket for healthcare into a flexible savings account. So what it really does, instead of paying for those bills with take-home money that you've paid taxes on, now you can pay for those bills with pre-tax money that you didn't have to pay taxes on. And so like it generally, even if you didn't use every dime of it, I think a lot of times it ends up still you win on the deal, right? Because you ended up because of the tax savings on those expenses.
What about for childcare and things like that? Are the flexible spending accounts good for that?
There are some that are for childcare. Yep, there's some different ones available, and really depends on what benefits your employer provides. Because a lot of employers have gone to these kind of cafeteria style plans, and so there's a lot of options, right? They want you to be able to spend your dollars in a way that's beneficial to your family, and so understanding that and really seeing, hey, which one of these is going to give me the most bang for my buck is where it really pays to have a good, certified financial planner you're working with, so you can go through those and really figure out a game plan for how to use those dollars.
Very good. Speaking of child.
Yes. Yeah, child tax credits, right?
Yeah, exactly.
Yeah, and child tax credits have become a little bit more prevalent. The CARES Act and some of those things have increased some of the amounts, and so are when the Trump tax plan back in, I guess it was 17, when that came into effect, what they tried to do was kind of increase some of the credits and increase like the standard deduction, so it was easier to file taxes, right? So you didn't have to do so many things, and so The child tax credit, so just so you understand, a credit is dollar for dollar off your taxes, right? So a deduction is just reducing your income, but credits are very powerful because let's say you had a $1,500 credit and you owed $1,500 in taxes, those would offset and you'd have no taxes due, right?
Yeah.
And so understanding that, and the good thing about the child tax credit, generally speaking, you're using an accountant or even TurboTax and you put in your family and everything, you're not going to miss that one. And that's why I always tell you, you don't have to do a lot of planning for that necessarily, because it's just be aware that it's something that's a benefit for you. And that's a good one that you just kind of can say, okay, I know that exists and I should make sure that's getting taken care of when I file my taxes.
The other one, which I've had some friends of mine talk about, is Roth conversions. I know some guys who are starting Roth conversions, and explain how that works, Dan.
Yeah, one of the big issues, and we spend a lot of that in our firm with clients on that tax planning and those Roth conversions, because what a lot of people get to when they get to retirement, and sometimes even before that, you can start looking at doing some of those conversions, is they have almost all their savings in pre-tax accounts, meaning 401ks, things they've never paid any taxes on. And you mentioned earlier compounding, right? And so they kind of like, it gets to be shocking sometimes how much money is accumulated in those types of accounts.
Mm-hmm.
The good news, you have the money. The bad news is you've never paid any taxes on it, right?
Yeah.
And so oftentimes that can be what's called the tax time bomb. So over time, you can all of a sudden find yourself getting to like required minimum distribution age, and you have these massive distributions you have to take, which puts you into a higher tax bracket than one you ever thought you might be in retirement, right? So that Roth conversion is really, it's just being proactive and saying, hey, I want to manage my taxes each year. And so if I've got some room in lower tax brackets, I can actually basically, in essence, remove money from my pre-tax account, put it into a Roth account, pay the tax today that I owe on that conversion. And then once that money's in the Roth account, now a couple things. It's going to grow tax-free, moving forward. So you're kind of paid off, if you will, on your taxes, and there's no required minimum distribution on that money, so you don't have to pull it out, right? So it gives you more control and ownership over those funds. And long term, if you do it right and you plan it out throughout retirement, you can substantially reduce the overall taxes you pay throughout retirement. And so that's one of the things. It gets very in depth, and we obviously today we can't get into all the details of a Roth conversion. But understand it's a way to proactively manage your long-term taxes in retirement. And it's not for everybody, but for many people, it can be very beneficial and really make a big impact on their money. And the secondary thing really we didn't talk much about yet, but if you've got a goal of leaving some money to kids, because you want to help them out, that can be the best money in the world to leave to them, right? A tax-free bucket of money versus something they get and they have to, pay substantial taxes on to get that money out.
Now, fair. And I, as much as I want to continue to talk about Roth conversions, maybe that's a better episode by itself. So
probably, yeah, it's very deep and it's really great stuff to talk about.
Yeah, and there are a lot of rules. There are a lot of things that need more in-depth discussion than what we're going to go into today. But let's go into an area that a lot of people can feel pretty passionate about and committed to, and I'm talking about leaving some kind of bequeathing money, charitable giving. What are some ways there in terms of tax planning that people should be aware of if they are charitably focused?
Yeah, and we're going to talk kind of about three areas of that on the charitable giving area. And one of them, which has really become popular, and many listeners may have heard of it, but they're called qualified charitable distributions. So one of the things that's really nice, once you reach 70 and a half, and you do have to be 70.5, 76 months before you make a qualified charitable distribution, that's money coming out of an IRA that you haven't paid any taxes on. And you give it, the check goes directly to that charity, that qualified charity. So what happens is, in the old days when more people could itemize, when the standard deduction was lower, what would happen is we just keep track of all that money we gave to charity, and then when we did our taxes, we'd be able to deduct those things when we added everything up, because a lot of us were above the standard deduction. Nowadays, most people are not above the standard deduction. And so they don't really get a tax benefit per se, to giving that money to charity. This way, you can give money to charity directly out of your IRA that's tax free. And so what happens, that money came out of your IRA, it doesn't go, it's not considered taxable income to you. And so in essence, it reduced that balance that you would have to pay taxes on as you took it out and went directly to a charity. So it's a great, great thing to do. I think the limits, I was looking at it, what's it up to? Like 108,000, which is a lot, but that's the maximum in a single year.
Yeah.
And when you do get to your age where you have required minimum distributions, it counts towards that number. So if you had to take out $20,000 in a required distribution that would become taxable income to you, you could conceivably give all that directly to a charity through a qualified charitable distribution, and then you'd have none of that income would register on your own tax return. So it's a pretty great thing to really understand and utilize for many, many people.
Yeah. And just to be clear for those who are listening, you can't take possession of that money. You have to say, I want this money going to organization A or B or whatever, right, Dan?
Yes, that's really important. So, and you need to keep track of it too, because you need to let your CPA or accountant know that you did that. Because when they get the 1099, it's just going to show the distribution. It's not going to show who it went to. And so you got to keep, like I always tell clients, keep copies of the check, right? So you show, and then when you do your taxes, they fully understand qualified charitable distributions. You could say, hey, here's the checks that came out of my IRA that went directly to charities. Now, you can get it mailed to you, and a lot of our clients do that. It just can't be written to you. You can't take constructive receipt of that money.
Right.
Right. So like you can get a check written to your church or to the American Red Cross or whoever and bring it over to them and drop it off, which is a good practice, but you just can't have it written to you. Right. Very important.
Yeah. What are some other ways we can look at charitable giving in terms of planning?
Yeah, everybody a lot of clients think of religious tithing, giving money directly to charity, and that can be done through QCDs or just regular. And, like I say, that it's going to depend on your own situation, whether that becomes deductible or not. But one of the other things that we really always recommend to people is if you can't do the qualified charitable distributions or, you're trying to maximize things in other ways, there's something called bunching of deductions. And what that really is, it's kind of like saying, hey, I can't itemize if I give my normal giving each year, like I'm below that limit. But what if I double up every other year? And I can itemize one year and then take the standard deduction the following year as an example. So you could do things like in Michigan, we have property taxes that are due like, September and February, but you could conceivably bunch up and you can pay you get the bill for February and December. You could pay that early. You could give 2 years worth of contributions to a charity in that year, maybe beginning of year, end of year type thing.
Yeah.
But the idea is you bunch them together so that maybe one year you can itemize and the next year you can't. So over time, you basically win by some margin, right?
Yeah. Yeah. No, that makes sense. That makes sense. Now, part of tax planning, it does involve retirement planning.
Oh, yeah.
So why don't you walk us through some of the things that people should be thinking about or be aware of?
Yeah, the big thing is understanding your savings plan. So we're going to kind of bunch some of these together. And by the way, I don't think we mentioned this will be downloadable, this checklist. So you'll be able to, listeners be able to get this and kind of review some of the details on these things. But when you think about your savings plan, right? Sometimes people think, oh, it's tax planning. Let's get all my savings into pre-tax. I'm going to tax break today. This is going to be great, right? Well, depending on where you are on the tax table, and if you have kids still at home, your tax rate may actually be low today, right? And so that means it might be better for you as you're figuring out where to put money to put it into the Roth option instead of the pre-tax option, right? So tax planning is about optimizing your total lifespan, right? So if you're at an age where you have really low taxes currently because of all the deductions and kids and things like that, the Roth option is probably better, right? If you're in high income, your earning years, your kids are all gone, you don't really have any deductions, pre-tax is probably better, right? But understanding how to do that and making sure you do it, right? Because the problem is like the years go by, and if you don't put something systematically in place, oftentimes a year gets over, you don't have the cash available, and you don't do it, and you miss out. And if you have a 401k plan like many of us do, which most of them now have Roth options and pre-tax, you're probably missing a match, right? So not only are you not getting money in and taking advantage of your current tax situation, you might be throwing money away because you didn't get the match as well.
So and most people know about traditional IRAs, and Roths. We know about many of us know about 401ks. But there are some other things that even I am not clear on. I'm talking about like 403bs and 457bs. What are those, and how are they good tools to use?
Yeah, and that's another reason why it's so important to have a qualified advisor to really understand what options you have and what might be beneficial to you. Because a lot of the premise is the same, like a 403b might be at a hospital or a nonprofit, right? So it's similar to a 401k with slightly different rules. But really understanding what those rules are and how much you can put in. Are there catch up provisions? Can I put more in if I'm over 50? There's a lot of different things, and there's some unique things around certain types of plans.
Mm-hmm.
And so, really, yeah, there's a lot of different names, but they give you similar benefits, right? It's the idea that it's putting money away for retirement. And so, yeah, I always recommend, because this is kind of outside the scope of today, but really make sure you're talking to somebody that really can help you understand what you have available at your job, and then how can you use it to your for your biggest benefit.
Yeah, and that is where somebody like yourself, somebody who is a financial planner, somebody who is qualified to guide you and tell you about this stuff is really, it's important. It is really, really important.
Yeah. And then the only other thing really to touch on in retirement planning, and we talked already a little bit about it, but understanding required minimum distributions. That is one of the biggest planning areas that people miss. They'll push it off and they don't really think much about it until that age hits 73, typically today as people turn in 73. And one of the quick things to note about that, the first year you have a required distribution, you can actually wait until April of the following year to take it. But if you do that, then you'll have two required distributions in that year versus just one. And sometimes that makes sense. Like, say somebody's still working and they have income coming in and they're like, I would rather have two next year than add on this year to my already higher income. But again, it's a big planning thing that you need to take a look at. So understanding what those are going to look like and making sure, you're proactive over time. If you can do Roth conversions and things like that to reduce that required distribution when the time does come.
All right, let's talk about estate planning, because we know it's important, obviously,
Yeah.
but give us a couple of guidelines, give us a couple of things, maybe three things that we should be thinking about or be aware of.
Yeah, the estate planning is really interesting because people sometimes think just when I'm gone, right? Which is important.
Right.
So it's important to understand what are your goals when you pass away. So just at a high level, if your goals, hey, I want to leave my kids the most money possible. Well, guess what? Things like Roth conversions and maybe life insurance and different things like that can really play into your situation. What if you want to leave a lot to charities? Well, guess what? Charities don't pay taxes. So you can leave them pre-tax IRA assets and they don't have to worry about that, right? Because they're not going to have a big tax bill on it. So the first step is really understanding who you want to leave money to so that you can plan ahead to make sure that is really, efficient and effective in getting them the most money out of what you have available. But the other couple things to remember, and a lot of people ask this question, hey, I'm getting to the point where I really do have extra money. My kids are kind of at the stage where they're, they got a lot of expenses, kids, houses, all that. I've heard I can give them some money, right? So like, what can I do? And so right now the gifting limit's $19,000, which is per person. So if you did have a married couple, you could conceivably give $38,000 to a child, or really to anybody. I mean, it doesn't have to be a relative. And if you're really feeling nice, you could give 38 to your child and their spouse too. You know what I mean? You could really amp it up quickly.
Oh, wow.
But big picture is that is available. And with that annual gift exclusion, what that means is that you don't really have to report it on your taxes because it's under that amount, right? If you go above it, it doesn't mean you necessarily owe any taxes or they don't owe taxes on it, but then you have to begin reporting it, which goes into what we call our lifetime exemption amount, which is a big number now. It's almost $14 million. But what it says is over the course of your life, between those gifts above the exclusion amount and, what you can pass at end of life, if it's below that amount, there's no estate tax. You get above it, then you start having, that 40% estate tax kicks in.
Wow, that is good. So it's interesting. I always thought that the annual gift tax had to be family.
Yeah.
I did not realize that, if you were in a situation where you knew someone who needed some financial help, and if you were able to give it, that you could actually use this to help them out. That's fascinating. I didn't realize that.
Yeah. Yeah. A lot of people do kind of think, and that's the most common thing, right? Giving it to kids and things like that. A lot of people, that's how they kind of help them. But yeah. And then the follow up to that, wills and trusts, like really making sure those are all done correctly, because you can run into some major tax issues if you don't do that right. And it may be for the people, that you want to leave money to. Like we talked a little bit about what goes to charities, what goes to kids, making sure that's all aligned in a way that's going to optimize the use of those funds at end of life. So that's another real important part of that estate planning.
Really good. I feel like we're getting near the end here, Dan, in terms of things to think about. But you got any closing thoughts or one last thing we need to put on the table?
Yeah, I mean, the biggest thing left is really and a lot of people have heard this. Obviously, we have a new administration, all that stuff. One that actually created the tax kind of system, if you will. How we're taxed today with the Tax Cut and Jobs Act when it was done. So, like that created the higher standard deduction, some of the other credits, different things, changed the tax bracket some. Those are actually set to end the end of 2025. And so that's something you need to be aware of, which could go into your Roth conversion strategy and a lot of different things, like if your tax rate may go up starting next year unless something is enacted by Congress, which a lot of people think that will happen, but there's no certainty on that. Anybody that's watched tax policy through the years, just when you think something's certain, it doesn't happen, right? I mean, Bill, you've covered this stuff for years and years, right?
Yes, that's why I'm laughing in the background. Dan, it's like the markets. There are no guarantees.
That's exactly right.
Where everybody may be talking about this like it is absolutely positively for sure certain going to happen. You really don't know, because it does come down to politics. It does come down sometimes to politics plus some economics. So it's not guaranteed what we're going to get at the end of the year.
No, it never is. And it's just important to know that it is. So what I always tell clients, plan on it ending the end of the year when it comes to planning strategies. We may get more clarity throughout this year, but what's funny? I think people forget, and again, you've covered this stuff a long time, but when you look at Congress and tax law and all these other things, they're off quite a bit, right? So if they don't get things knocked out during certain times of the year,
exactly.
It's not getting done, right?
No.
So it's real important to understand that.
That is true. For Dan, for people who listening to this conversation who are not clients of yours or maybe not familiar with you, but thinking this is a conversation I would like to continue to have with Dan, what is the best way for them to reach out and get a hold of you?
Yeah, we always recommend people go out to the website, averywealth.com. It's got a ton of good information. You click on the Insights tab. A lot of these things, like we're talking about, these checklists, different reports you can download, just a lot of opportunity to learn. And then right on there, you can contact us, reach out. We're happy to have a call, answer questions you have, see if it makes sense to come in if you want to learn more about what we do. But I will just mention, when it comes to taxes, this is kind of near and dear to my heart, because this is one area where families can really have a big positive impact on their overall situation if you're proactive about it. And the funny thing is like, it's not like one major thing that applies to everybody. As we covered a lot of stuff today, it's the idea of, hey, it's all these little things and really figuring out what applies to your family and how to leverage it. You want to talk about compounding. I mean, if you make some wise tax decisions, the compounding effect of that can be just amazing over the course of your life. And your kids too, honestly.
No, that is true. That is true. And it is always good to remember it's not necessarily just one generation that you're talking about here.
Yeah, that is a great point, because it oftentimes, goes into multiple generations and can really just have a big long-term impact.
Yeah, and the only other caveat I'd add on there is that, you hear about multi-generational wealth when they talk about athletes, and they talk about people who are making hundreds of millions of dollars and unimaginable sums of money. But it's just as true for people who have far, far less money. And it is how you care and plan, right?
There is no question. It's funny. Like when I was a kid, I don't know who even taught me this because the years go by. But they said to me one day, I think it was out on the golf course. I used to work on a golf course, and it was some guy that an older guy that had golfed. He's like,
Yeah.
Everything's relative, is what he said to me, and I just was kind of like, that is stuck with me forever, because it's everything's relative. Like your level of wealth, whatever it is in your family, it's all relative, right? If you can consistently pass that on, it's going to have an impact,
Yes.
right? And so it's just always remember that, it's don't worry about what the neighbor has or what the coworker has. It's like optimize what you have. And that's where I think you get true happiness, just having that confidence around your money.
Couldn't agree more. For those of you who are intrigued by this conversation, do reach out to Dan. Go to averywealth.com and look what he's talking about. The tax checklist that we've been discussing, by the way, is in the show notes, so you can download that as well to take a look at it to make sure you're thinking about all the things you need to be thinking about in terms of planning your future. The other thing you can do that doesn't involve any planning at all is just reach out and hit the follow button on this if you're not a subscriber to the podcast already. That way, every time Dan drops a new episode, you're notified. It's that simple. Then you can listen to it. And the thing I would add here is if you like this podcast, if you find it interesting, if you find it helpful, you find it useful, please tell people about it. Word of mouth promotion is very welcome. It's a very effective tool for promotion, as a matter of fact. So until next time, I'm Bill Tucker. On behalf of Dan Reese and everybody at Avery Wealth, thank you for taking the time to listen today, and we'll see you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.